So we show people how to wholesale, get it under contract, how to assign the contract, how to get it to closing. So that's another way to build your capital stack. And then once you have these various tranches of your capital stack built, then we show you how to invest that capital stack.
Charlie, welcome to the podcast. Thanks for coming today.
Well, thanks for having me.
Yeah, I know we've done some deals before in the past. You've been around for quite a bit, have a wealth of knowledge. I'm excited for the customers and myself to learn about what you've been up to.
Well, with your title company, Allied Title, we've used you guys quite a bit on a bunch of deals, primarily on the hard money side with your title company. And so hard money is obviously asset-based lending. So we have a pretty good size asset-based lending company called ClearStack Financial. And so we use you guys. We do between 10 and 16 loans a month.
Right.
And so I would say, those 10 and 16 loans, we probably do 2 or 3 through you guys.
So you didn't start off necessarily in hard money. I don't think. Were you doing your own fix and flips to start? Is that true?
Yeah. So our start was in the distressed asset space.
Okay.
We bought a ton of pre-foreclosures. So between 2002 to 2006, we were in the pre-foreclosure market. What a pre-foreclosure is somebody obviously going to foreclosure. They get advertised in a newspaper. They have the loan amount usually on the debt that's being foreclosed. And so properties that had equity, we targeted those properties, and we were buying up properties from the owners between that time frame. And so what we did is that's how we built our capital stack. But the caveat to that is we had to buy properties and close them in a week or less because the homeowner had an auction deadline that we were trying to beat and get to closing. And so that's how we built our capital stack to start the hard money business. But along the way, though, instead of flipping all those properties, we kept a lot of them into a residential rental portfolio.
Okay. And how many were you buying a month back then?
Between 2002 and 2006, before the crash in 2008, we were probably doing 2 or 3 a month. We were new, so we didn't have much money. As a matter of fact, when we started, I'm a dinosaur. Let's just start with that.
I'm excited to hear. Let's tell everything. What you've learned over the years.
Well, not only that. So when we were doing it, there was no such thing as hard money lending, right? You might see it as subprime, but even the subprime lending wasn't lending into asset-based. Mm-hmm. So there was no such thing as hard money lending. We had to go to community banks for our funding. There also wasn't this thing called wholesaling. Okay. In other words, back in our day, you bought the house in a distress, you didn't wholesale and sign the contract.
You had to put up money? How much would you have to put up?
That's right. We had to put up money. So we had to put up 25% on the purchase, and we had to carry the renovation because we had relationships with these smaller community banks like Burke and Herbert, Freedom Bank of Virginia, at the time, John Marshall, Sandy Spring, all these smaller banks we had relationships with, but they weren't having any part of that. 25% down payment, plus we carried the renovation, so we had to spend a lot of our capital.
So when you were starting that with not much money, whose money was that? Was it your own money you'd saved, or did you have an investor? What did that look like?
Sort of. It was between the money we saved, it was between credit cards, and it was between HELOC. Yep. Right. So both me and my partner owned our primary residence. We had a little bit of equity, so we both had HELOCs. Yep. So we had to go to different varieties of funding sources. And today they call that gap funding. Okay. Right. So back then there was no such thing as gap funding. Yeah. So we used pretty much our own money / credit lines.
But I mean, what you did do is you believed in what you were doing. You figured it out. You put your neck out there and you made it work. I mean, a lot of people today are, where do I start? I don't have money. I mean, let's just say you didn't have much money back then, but you figured it out. You went into those sources. So I know you've written a book and you got some classes on education. Is that something you teach people a lot, like how to get started?
Yeah, that's right. So one of the things that we did, the name of the book is called The Roadmap to Wealth and Real Estate Investing. Mm-hmm. It's on Amazon. And so then what we did is we created classes off that. But we had always been doing classes before the book. Yeah. My number one class was how to find distressed assets. So we go through all these different techniques on how to find a distressed assets. And we've been doing that. We did that in a couple national symposiums, Think Realty. We traveled around the country and did it. We do it locally for various title companies or various, let's say, real estate investor groups that we sponsor. Yeah. And so what it does is how to find distressed assets takes you through all the different asset classes. It takes you through pre-foreclosure. It takes you through REO, real estate owned. It takes you through the auction bidding process at the courthouse steps. It takes you through driving for dollars, or some cases walking for dollars, looking for vacants and blighted, adding them to your list. We also got into death and divorce, estate properties, divorce properties, any kind of familiar issue kind of property. So we went through all these different categories on the levels of distress. Yeah. And so that really was our claim to fame. Yeah. So we had that presentation out there for a long time. And then once the book came out, we decided to launch the course on the fundamentals of real estate investing, right? For the newbies who don't know anything about it. Financial literacy of real estate investing, right? Because people have got to understand the financial aspects of it.
Sure.
How to find distressed assets, how to find the money to invest in the distressed assets. Obviously, hard money being one of them, but community banks, we call that soft money. Your normal mortgages, cash, using HELOCs, using self-directed IRAs, using all these different funding sources to purchase properties. And then we have courses on how to fix and flip, building your capital stack, how to wholesale, even though wholesaling didn't exist, now it does. So we show people how to, wholesale, get it under contract and or assigns, how to assign the contract, how to get it to closing. So that's another way to build your capital stack. And then once you have these various tranches of your capital stack built off your profitability from the wholesale or the fix and flip, then we show you how to invest that capital stack. And that's the part where people don't bridge the gap, right? They have all this money sitting out there. They're like, I don't know how to invest this money. And everything that we show them to do is on the real estate front, whether it's to lend out your own money and be a hard money lender, whether you just don't want to be a hard money lender, but you want to lend in this pooled hard money kind of capital raise type scenarios where you're getting paid 8 or 9% on your hard money. So you invest into a pooled mortgage fund. Do you want to invest in tax lien certificates, which is in DC? Do you want to build your residential rental portfolio, which we've already done? Do you want to even invest in commercial properties? And investing in commercial properties is probably one of our bigger classes that people like because we teach them how to invest in commercial properties, cap rates, that kind of thing. How to analyze the investment, how to make sure it's a good investment, how to invest in syndication. So there's a lot of ways to invest that capital stack that people don't realize on how to do it.
One of the things that some of my friends do, especially ones that are builders, which I'm too lazy to do this, is, they build a new house, stay in it for 2 years, sell it, take that all tax-free and keep doing. Do you do that yourself? Have you ever done that?
No, because you're gonna find this is funny. My strategy of that is I'll buy a primary residence, but I'll buy into equity. So I'll either buy it at the courthouse steps or I'll buy a pre-foreclosure myself. We'll get in there, live there for a couple of years. The first thing that I do though is once I get the mortgage, right, I'll then get a home equity line of credit attached to it, HELOC. Right. Then 2 years later, buy another house, same kind of strategy, usually at the courthouse steps. Get in there, rent out the house I just had.
Still have the HELOC.
Still have the HELOC. Equity on that's building. Buy the house into equity. Same thing. Get a normal mortgage. But first I'm buying it all cash or I'm buying a credit card or whatever. I then get a normal mortgage, pay that back. Then as that equity grows a little bit, I then get another HELOC. Every 2 years I do it again. That's been my strategy. And the reason behind that is because not only do I get another rental in my own personal name, not outside of our corporation, but I'm able to build these, what I call liquidity tranches, the different HELOCs. I don't use the HELOCs to buy a car. I don't use the HELOCs to go on vacation like a lot of people did in 2007 and 8. I just keep them out there in case I need liquidity for a real estate deal that I've got to close in 48 hours.
Makes a lot of sense. Does it ever make sense? Well, I believe it's if you've owned it for 2 of the last 5 years, do you ever get to the point where, you haven't lived in it for 2 to 3 years, but you're like, this has gone up a lot, and then you sell it because you're going to get all that tax-free?
Got a funny story. I've only done that one time. And the only time I did that was when I got divorced. We were in this thing called a marital home. So we live in the marital home and it went up dramatically in equity. Well, I was what's called the out spouse. So I had my ex-wife she didn't have enough income or credit at the time, but I still owned the house with her for about 10 years. So in Northern Virginia, obviously the real estate prices went up. So finally she got to a point where the interest rates were really low. It was like when we went 30-year fix was like 3%, 3.5%. She made a little bit of money. She was able to refinance out my position in the house because we had lived there, or she had lived there. I got the $250,000 IRS exclusion for being an out spouse. So I was able to take my refinance buyout amount and take that tax free. So I did do that one time.
All right, that's I've never done it consistently, but man, especially if you're a builder, it seems like a great idea. I put so much effort and time into my house. I can't imagine starting over. I mean, God, that'd be so much work.
Yeah, but what's in your house? Don't you have a lot of stuff in there?
Yes.
It's a pain in the ass to move.
Well, that's the other thing. Moving that and man, very cool. And so eventually, it's interesting because you pointed out, like back when you guys started, there wasn't hard money, there wasn't wholesaling. So when did those come about?
Our first foray into the hard money lending business was about 2011 or 12. And that's because one of my friends who owns Restoration Capital, Brian Castell, knew what he did was, see, I was an avid bidder at the courthouse steps. So I was in Prince William, I was in Fairfax, I was at all the auctions in Prince William, and I was at most of them in Fairfax. Well, Brian Castell showed up one day and he already knew a lot of the other bidders at the courthouse steps. I met him for the first time. He literally, I'll never forget this. He literally took us out to lunch at Hard Times. What's that chili place? Hard Times across the street from Fairfax County.
Sure.
He sat us all down and he gave us a pitch on his company. This was back in 2011, before we started our business. And so he pitched us on hard money. And I was like mesmerized. I was like, what in the hell are you talking about?
Yeah.
You mean you're going to do a hard money loan on the hard asset itself? This is incredible.
Right.
So that was my first foray into knowing about the hard money business. So that came about in 2011 early, because what had happened was in 2008, 9, as we all know, the subprime market crashed and those guys went by the wayside, which really opened the door for this new business line called hard money lending. Yeah. So then let's dial it forward about 3 years. So from 2011 to about 2014, we were buying about one house a week at the courthouse steps because the bank, remember the bank REO crisis?
Yeah.
Well, instead of the banks taking them back and doing REO, real estate owned, and sell them out of their portfolio, they were literally dumping them at the courthouse steps. In fact, that's where we built our rental portfolio. Yeah. So we had 6 entering into 2009, had a $500,000 capital call from Freedom Bank of Virginia, because even though the assets that we had bought at good prices, our loan to values had shrunk so much, we had to give them a $500,000 capital call. That wasn't fun.
Yes, never is.
Oh my God. Yeah. So then what happened was we started buying more and more houses at the courthouse steps starting in 2010. Actually, it was the back of 09. So we were buying about one a week. So that's really where we built up our residential rental portfolio, because I was able to buy fairly new townhouses in the Route 1 corridor of Woodbridge and Dumfries. We were picking those guys up between 150 and 170 at the time. They were built in like 2005 or 6. So we were getting fairly new housing inventory, but I was getting between 150 and 170, and the rents were between 18 and 1900. Yeah. So I was getting more than 100 times rents. Yeah. So we just socked those guys away. Okay.
Great. Still have them?
Still have them.
That's amazing.
We got about 50. Still have them. And so, of course, you can just tell the equity growth, but we use that equity growth to drive our private lending business, which we got into about 2013. And the only reason why we got into it was because of the Brian Castell meeting with Restoration Capital, me understanding it or knowing that that business model existed, but also because we had an infiltration of Middle Eastern money into the auction space. Yeah. So it was driving up the prices, but it was really narrowing the fix and flip margins. Right. So we were like, we're sitting on all this cash. I've got to get into something else. Yeah. So we were looking at other marketplaces. We developed a car wash and some other things. But what had happened, though, is one of my buddies at the courthouse steps came up to me and he goes, hey, Charlie, and so what you have to understand about the courthouse steps bidding process is that you see the same people from auction to auction to auction, years and years. So you get to know them personally. Yep. You get to know what they buy, how much they buy it for, their family, all the stuff that they do. You get to know them on a personal level. So this guy named Jimmy Nguyen took me aside and said, hey, Charlie, I just bought a condo in Fairfax County. It was worth $325,000 or $350,000. I bought it for $225,000. I put up $25,000 in a EMD check to the lawyer. He goes, you're going to give me a $200,000 loan against this condo. Because he knew that he just knew me from years ago. We bought a lot of houses. So here's what I said. I said, yes.
Yes.
That's all I said.
Yes, that's great.
I started thinking. I just said yes, because I had no idea what I was doing. I had no clue. So then guess who the first call I made to was? It was to Brian. And I said, Brian, I got some request from Hard Money. I kind of want to do it. I like you. So I could put it through you. I said, but I would kind of like to do it. And so, Brian helped me out with the one-page term sheet. Yeah. Right. We had a real estate lawyer through another title company called Green Dot Title, Centerview Title now. And so he was able to so Brian gave me the one-page term sheet. I sent it out to Jimmy. And of course, I modified it a little bit. We created a company called Clear Sky Financial. We went out there and got our own logos. And so I did a term sheet. He signed it, sent it back. We closed the deal a week later. And that's how we got into the hard money space.
We work with a lot of hard money lenders, and I hear a lot of them speak to, there's different philosophies, but one, Brian Athey, I think you know him. He, it's a relationship play for him. He wants to know the people, and that's how he determines to lend. And there's other lenders out there that maybe not, relationships not as important. It's more high volume and stuff like that. But, you're playing, that was a relationship example. You know who these people are. You're seeing them all the time. They're paying their bills or doing their best to, right? And that's kind of part of how you make that decision, right?
No, that's exactly right. And for us, just like Brian, just like Athey and Castell, for us, it was totally a relationship business. But one of the things that I didn't realize, and we all know this, I did realize it, but I didn't, is the power of the word of mouth, right? That marketing, nothing beats that, right? So what happened to us is once we did the loan for Jimmy, it spread like wildfire. Everybody was like understanding that we were in the hard money business. And then I got a lot of demand from folks that I didn't know. Let's say one step away. It wasn't somebody that I knew directly. The only people I wanted to deal with at the very, very beginning was folks that I knew. I had to know them. And if I didn't know you, let's say you knew somebody that needed a hard money loan and you had them call me for a hard money loan, even though I liked the deal, I had to go meet you and look at you eye to eye and understand what you're doing in the investment space, how much knowledge you have or don't have, and what your goals are. If you were a first-time investor, which most of my folks were at the very beginning, I love first-time investors because guess what happens to first-time investors? Once they do a couple successful deals, they're going to end up doing 20 or 30. That's who I wanted. I didn't know at the time, but that's exactly who I wanted. And that's who actually built our business. So at the very beginning, and when I call the very beginning, I call it the first 5-7 years, the very beginning, because that's the way it was. I had to know you.
And it makes a lot of sense. And were you also, if you looked at someone, I mean, they have to have some kind of edge, right? So if they didn't have it, would you coach these people into that?
Of course. So for us, and that's where the coaching and mentoring came in before we actually formalized it. In that, let's say you were a beginning investor and let's say you brought us a great deal. I'm not penalizing you because you're a beginning investor. If you didn't have the contractor, we were supplying it. We were going to help you with that. If you didn't have a real estate agent and you weren't a realtor, no problem. We're going to supply you with the agent. Now, I'm licensed in Virginia as an agent. I own a brokerage that's licensed in Maryland, DC, and Virginia. And we learned the hard way to not list houses on the real estate agent side of properties that we're doing hard money loans on.
Give us some examples.
It was actually from the guy that got us in the business. And so he bought a good fix and flip off of Gallows Road in Fairfax off of Oak Street. And I remember this like it was yesterday. And this was like 12, 13 years ago. And so he made a good deal on it. And we were the hard money lender, but he also wanted us to list it under Green Dot Realty. And of course, the reason why he wanted us to list it is because instead of charging him a 3% at the time listing, we only charged him like 1.5%. So we divided it by 2. But we already had the hard money loan. Well, we advised him on the price of the asset. We were like, I don't know, something like $699 at the time. You should list this at $699. He did a good job on the renovation and it would have sold. It was into a market that was kind of stabilizing a little bit, maybe going down slightly. Well, he didn't take our advice. He listed that thing for $799 because he's a client. We're like, okay, we don't think it's going to sell at $799. We think our price is $699. Well, he stayed there at $799. 30 days goes by, 45 days goes by. He finally drops it to $749.9. We found him a buyer at like $720 or something like that. Well, he didn't want to take the buyer because it wasn't $749.9. He got really mad at us. And so one of the things he came back to us and said, you guys don't care to sell the house. All you want to do is keep tinging your hard money interest fees each month. And that really wasn't the case because what he didn't understand was we needed to get that house sold because I needed the money back so I could re-lend it out to the demand that I have. So it doesn't do us any good. But because he thought that we had the listing agent relationship with us being the hard money lender, he sort of didn't appreciate that. So we were like,
that's interesting.
We were like, ever since that point, even though Sam was licensed in Maryland, DC, and Virginia, I was licensed in Virginia, we were like, oh no. So we were like, we're never going to list any one of our hard money clients' houses ever. We're just going to refer them out to investor-friendly agents.
That's interesting. Did it eventually sell?
Yeah, it sold for like $725 to a government worker. They were in the black world, and so they could afford it. And oh no, by the way, the client that we listed it for was the one who found the buyer, not the MLS. So I got to give him kudos on that. But that was a bad experience. It was a learning experience, but just like anything else, I think for us, you learn more from your bad experiences than you do your good experiences.
You'd mentioned like some of the stuff you teach on is whether it's divorces and all these other ways to buy distressed assets. Tell me about your team. Like, do you have a team that's focused on all of these things still to this day? Do you guys still do that yourself? Do you not do that anymore? Or what does that look like?
That's a good question. You're looking at the team. So our team is very small. What has happened over the time is, let's take our rental portfolio, for example. We have Heather. Heather's been working for us for 15, 16 years, maybe longer. She manages not only all of our residential portfolio, but she manages our commercial. So all of our back end's taken care of so that we can buy more and add it to the rental portfolio. On the hard money side, right, you're going to laugh your head off. Remember I told you we're doing about 10 to 16 loans a month. I don't have a loan officer. I field all these calls all day. My phone doesn't stop ringing. But I see a lot more bad deals than I see good deals. Then once I send the term sheet out, I pretty much go away because Sam and and Alex take care of it from a loan doc and getting it closed standpoint. Then once the loan gets what we call in production, then Karen manages our online software called the mortgage office.
Okay.
And so we have all of our back-end processes systematized. So even on the residential rental side, we go through Propertyware. And let's say I have 50 residential rentals, 49 of our tenants pay their rent online.
Okay, very cool.
Everything's systematized.
Is that through that software that you're talking about? Yeah, nice.
Same thing on the loan side. It's called the mortgage office. Let's say I'll be simplistic. I have 100 loans out there. 90 to 95% of our borrowers pay their interest payments online.
Nice. Is there, I assume there's a fee of some kind. Does that fee go to the borrowers?
That's a good question. I wish you didn't ask it, but I'll tell you the fee.
But it's convenience.
We have the fee built into our promissory note.
Cool.
That once the loan closes out,
Yeah.
we charge like, I don't know, $50 a month or something.
Yeah.
So if the loan's out there for 6 months, we'll charge them $300 on the loan payment.
Is that an ACH transfer? Is that what that is? Or the payment?
Okay. ACH, and we get the money right away.
Cool.
And the funny and the interesting thing about it is that us being in the private lending hard money space is that all of our loans are due on the first of the month. And there is no grace period. So it's not like it's a normal mortgage, where let's say the loan's due on the first of the month, then you got a grace until the 5th or the 15th. No. If it's not due the first of the month, then we don't have a grace. But with some of our good clients that we like, if they're in there on the 2nd or 3rd or 5th, we just waive the late fee. No big deal.
Yeah, no, I mean, but if you think about it, 100 loans, and let's just say you're getting 100 checks, it's a lot of manual labor. I mean, you think about the time saved by doing electronic payments. That seems like a no-brainer. It's smart.
That's right. So on the system side, by building out the back-end systems, because the thing about it is I have an engineering background, electronic engineering degree. I was a data guy for a bunch of years, and then Sam is an MBA out of George Mason. So between the two of us, using my engineering background and his systems-oriented business background, we were able to systematize the back end.
So you guys built these systems yourselves? Or are they third party?
Yes, that's right. Evaluated third parties and figuring out what was best for us, because we try and close our books once a month. So all this back end stuff feeds into QuickBooks, feeds into our accounting, because we have a girl who's a CPA that's our bookkeeper and closes our books once a month, usually by the 15th.
That's awesome.
Yeah, it's pretty good.
Well, you got to figure it out. All right. Yeah, I was wondering, I was there here listening to all these strategies. Now, those strategies define distress. I assume at this stage, though, a lot of it is referral based. So you're not out there grinding as much on the finding distress, right?
Right. Everything's referral based for us, like especially on the loan side. It's all word of mouth for the most part. I mean, it's kind of like you and your strategy. We've recently had to launch our social media platforms. I mean, I always had LinkedIn, but we just launched Instagram. We just launched Facebook. I mean, and YouTube, we've been out there for a minute, but we've never had to go into the social media world, because everything for us was word of mouth. And I'm still scared to this day. I was always scared that the social media blitz was going to outperform our hard money company. And what I mean by that is the last thing you want to tell a client of a deal that you like is we're out of money. You never say that. I have never repeated those words to anybody except on this podcast. We're out of money, even though sometimes we stretch a little bit.
Sure.
Because if a client that has a good deal hears that you as a hard money lender is out of money, what are they going to do?
Yeah, I'm going to move on to a competitor.
They're going to move on to a competitor, and they may never come back. So those are words, because I get that stuff all the time from folks. They'll call me and they'll say, hey, I got this great deal for me. They'll call me and they'll say, hey, Charlie, Clear Sky Financial, you still lending? I get that question all the time. I'm like, of course, we're still lending. I got a good deal. And I say, oh, hey, how are you? I haven't heard from you in a while. How are things going? So we get this rapport, and they go, yeah, I'm using such and such as a lender. And then, of course, my first question is, let me guess, they're out of money.
Yeah, right.
And so, of course, they're like, they're out of money. Here's a deal for you to do. Just do the deal. And that's one of the things that you don't want to hear.
For your money, do you have private investors? Do you have lines of credit, combination?
The answer is just everything.
Okay, there you go.
So the way we're set up is that we're called fund managers. We have a 506B and a 506C fund, right? They're under this thing called Regulation D. And so we have I'll make it simple. We have about 40 million bucks right now, and I'll split the pie up to, let's say, a quarter, 10, 10, 10, 10, right? 4 10s. And so they're in $10 million tranches. So we have about $20 million from investors in our pooled mortgage fund. But add that $20 million, myself, Sam, and Ed, myself and Sam are the partners, but Ed's also a partner too. So between the three of us, we actually comprise of add that $20 million investor pool, we have probably 7.5 of our own money in there of the investor pool.
Right.
Then the other 10 million is from commercial lending and other bank sources, lines of credit, because that helps blended rate. And the other 10 million is basically equity within the fund. So that's how the 40 million is broken down. It's pretty simple. And so we're always raising money because I've got a lightning fund out there, a 506c fund, which I could only take on accredited investors. That's a $30 million debt offering that's just sitting there it's not even populated yet.
You figured it out, Charlie. You got a nice little business here.
So we started this hard money business back in 2013.
Yeah.
I was taking investor money at $100,000 a pop, $200,000 a pop. But what we were doing is we were only doing 1-year promissory notes that we were personally guaranteeing. So what had happened though is once your year went by, you went month to month. So if you wanted your money back, you just let us know, we give your money back. The problem is all of our investors that came in from the beginning being year 0 to let's say year 3 or 4, they never took their money out. Things happened. We got up to about $10 million 5 years later. The Virginia SEC came a-calling, State Corporate Commission. They call up and they say, I notice you guys have a hard money business. I need to know every single investor, and I need to see every single wire that have come and gone the last 5 years. So we had to give them all this information. And they never really told us what they were investigating, but they did hint at, because your promissory notes are a year, that is okay by the law. But when your investors have been on there 3, 4, 5 years on the books, we construe that as a bond. So because you're running your business at this thing called a bond, we're thinking that maybe we have some problems. They didn't come out and accuse us. They didn't come out and fine us, none of that stuff, right? So then what we did is we were very proactive in that. We were part of this thing called AAPL, American Association of Private Lenders. And so what we did is, thank goodness for us, is that we went ahead and opened these 2 funds. We opened up the B fund and the C fund. And the reason why we did the B fund is because I was able to have what's called non-accredited investors, people that are worth, for simplicity's sake, less than $1 million, because we already had my kids in there, Sam's kids were in there. We had other friends and families that we knew aren't accredited and are investing with us because, that's, for them, that was a good investment, probably the best investment of their lives. And so we created the B fund around this $10 million at the time, and we created with $30 million to give us an extra $20 million in room. And so we just took the entire Clear Sky Financials book of business, sunk it into the 506B fund.
Yeah, that's smart.
Then we went back to the state SEC and told them about our fund. And they basically wrote us a 1-page letter forgiving us and saying you are no longer being investigated, no cost on our end, no cost on your side, even though we accrued lawyer fees to sort of defend us getting ready to fight them in court. Thank goodness that never came about. And that's what happened.
I like the proactive work there, and kind of knowing who to go to, and like going to, was it like an association, the lender association you went to? Nice. All right. Well, we have a section called rapid fire here. All right. Fastest deal you've ever closed.
18 hours.
That's impressive.
18 hours. It was a title company. It was a hard money deal. The title binder was already pulled, and we were simply replacing out another lender that couldn't fund the deal. And this borrower would have lost the deal if they didn't have it funded. But the binder was out there. That was the key.
What's the most common reason someone gets denied a loan in your business?
Being dishonest. As a matter of fact, I have a loan right now that I'm vetting out as we speak. And the person that put it under contract is a licensed real estate agent. And they supposedly have fixed and flipped many houses. They did not do the real estate disclosure. And so for us, remember, we're vetting the asset, but we don't do too much vetting of the borrower. But whenever we see anything that has to do with dishonesty or deceit, I'll turn the loan down.
One feature you always remove from an outdated house.
Usually a wall or 2 around the kitchen. So one of the things that we always do, whether in Washington, D.C. or even Northern Virginia or even some of the older houses in Maryland, is we look at the kitchen, we try to remove non-load bearing walls, open up the main level. We do that all the time.
Do builders even build that way anymore? Meaning like they leave everything open in the kitchen now today.
Not anymore. Not in the last 7 years. Like before, let's say 7 years and prior, they were creating choppy houses. As a matter of fact, I live in a choppy house that drives me crazy.
So we bought ours and we renovated, and everyone in our neighborhood is opening up the kitchen. It's Pulte homes from the 70s.
There you go.
Worst flip you ever did, and what happened?
Well, those are called rentals. So there have been a couple, and I can't say the worst flip, but there have been a couple where we bought at good prices at the courthouse steps. We were going to make money, but the market dropped. That was like back in 2008 when the market just absolutely, the bottom fell out. And so we just converted them into rentals. Fortunately for us, we were very we had a lot of financial stability, and we were allowed to put those things into rentals. So those were our worst flips, but now they're called our best rentals.
It makes sense. I mean, look, it might not sell as well, but people still need homes to live in, and they get good deal. I like it.
Also, too, though, the market bailed us out. And that's not something I always say. I think if you're buying buying a house, you cannot hope the market's going to bail you out.
You can't hope that you're going to get an appreciating market, right?
Right.
I mean, like, you have to be prepared. You have to have cushion in there. On the cushion note, that was one of the questions we had. You know, what's your loan to value? What's the cushion you look for when you're going to lend?
Okay, for us, it's simple. So we don't base it like most lenders will base it on the purchase price,
Mm-hmm.
loan to value of the purchase. That's not what we do.
Yeah.
We base it on loan to value of the after repair value. All I care about in this hard money asset based game is what is the maximum use of that asset? How much is it worth? All right, let's say it's worth, I don't know, $600,000. Let's say it's in Fairfax. Let's say it's built in 2020 or something, or let's say it's built in 2015. I will lend 75% of the loan to value of the after repair value.
Yep.
I get that number. Then I look and see what you bought it for.
Yep.
Then I look and see what your renovation budget is.
Because you guys are a broker, you have a very good idea to get that ARV correct.
That's right. I'm the underwriter.
Yeah.
So I'm the tip of the sword. So I'm in the MLS all day just churning numbers.
Yeah.
I'm really what's called the real estate bookie. I'm online all day evaluating hard money loans, and I'm evaluating fix and flips, and I'm evaluating wholesaler deals.
Sure.
That's all I do.
Best borrower. If you had to write it on paper, I want this borrower. What does that look like?
The best borrower is the borrower that's prepared. Okay. So they send me the address, they send me the deal, right? Renovation, after repair value, purchase price. They send me pictures. And oh, by the way, they also tell me how much cash they have to put into the deal.
Mm-hmm.
And it's a borrower who's good at the comps. They know what their after repair value is. And also, too, they actually have a real live renovation budget down to the draw schedule.
That's what I was going to ask you about is the renovation schedule. Do you make sure that they've actually been given that quote from a contractor? Is that part of it? Like, you know, a lot of people think they can renovate for XYZ, but they're just not accurate.
Yeah.
Or do you just say that's just not right? I know what it would cost. It would be this.
Yes to both of those questions. So one of the things behind the pictures, like the pictures tell a lot of stories, right? So I can see if the house is vacant. I can see the systems that need to be replaced. I can see paint, carpet, that kind of thing. I can see roof, windows. So I know how much that's going to cost. But the thing that you have to understand is that the majority of my borrowers are contractors. Some of the contractors have warehouses with materials already in them.
Yep.
So the only thing that they're really paying is the reduced labor price.
One thing I like about hard money lenders, and you guys might not get enough credit for this. Some people are like, your rates are too high. However,
That happens.
there's but there's a couple ways you can go into business. You can, like, for example, what I used to do is I used to partner with a contractor or a builder. And then, hey, you're going to build a cost. I'm going to finance the deal. We'll split profits 50-50. Well, that's really expensive. You know, I'm splitting 50% of the profits with someone. Whereas with you guys are basically equity partners because you're going to do everything you can to get these guys the best deal possible so that you guys can get your money back. So if you really think about it, yeah, you're paying, I'm going to make up a number, 10 to 12%. But, you know, in my model, I'm giving up 50% of profits over here. And with yours, you're keeping all the profit.
Well, that's the thing. That's what people don't realize. And that gets back to who my best borrower is. I'm going to add one more statement to that.
Yeah.
My best borrower is somebody who can execute really, really fast. Because what people don't understand in this business, and I think you understand this, is that they might look at a 12% or 13% interest only as being, oh, that's the high interest rate.
Yeah.
What they don't really understand is my overall return is actually based on the points.
Yeah, sure.
Right? So the faster I get that money back, the better my rate of return is.
You're private lenders, so you're paying 9%, or whatever that number is.
Right.
So you're not really making that much money.
Exactly. Yeah, we're not making that much money because the 12%, if my blended rate is running between 9.25% and I'm 12%, my margin is 2.75% on the interest. Don't feel bad for me. But the 3 to 5 points that we charge, if I could take that same money over 6 months and re-lend the same money, then the points double. So we make our return basically on the points.
I think people are learning what's going on with this industry. This is good. All right. What's one market in the DMV that is full of opportunity, in your opinion right now?
Washington, D.C.'s back. D.C.'s back.
So I've been hearing that over the last 3 weeks. Is it possible like that's happened really in the very recent history? And why do you think it is?
D.C.'s back, and I'll tell you why. A lot of events, and you're gonna find this really strange. The first event, crime. They've done a much better job with the crime bills and all the stuff that they're passing, and they're doing a better job, especially around metro stations. And they're making people feel safe again. Right? It's all psychology.
Sure.
Number two, We just went through a bad market in DC where prices went up so fast and furious that, especially there were a lot of condo conversions.
Yeah.
We had it over. So DC does not have a housing availability problem. They have a housing affordability problem.
Right.
Those are two different problems. And
Sure.
so interest rates going up hurt DC dramatically. The first time home buyer programs, HPAP, not being available, underfunded, hurt them. Now they're starting to get on more of a stable ground. Now, the other problem with Washington, DC is it has to be reinvented.
Yeah.
We're going through an office space crisis right now in Washington, DC. And some of these office spaces have got to be repurposed.
Yeah.
And so what's happening is people are starting to feel safer to go back into the city. So if the property is worth, let's say, $800,000, $850,000, I'm starting to see buys between $400,000 and $425,000 because these properties need a lot of renovations. So it's starting to make more and more sense for investors, and the end user buyers are coming back.
Yeah, I mean, I feel like the government there has been pretty anti-business compared to local states for a while. And that's a problem because you're not going to want to go take a chance on investment. You know, if Attorney General is suing everyone, even if honest companies or whatever the case may be. So I'm hearing more and more pro-business talk coming out. I think they probably got a little scared when they saw the NBA teams trying to leave. Like,
That's right.
a lot of people were getting
That's
out of there,
right.
which increases crime.
Right.
So you want local businesses there. You want to be pro-business.
Right.
This whole theory of like businesses are bad is such crap. And I'm glad to see DC is hopefully. I just had a conversation yesterday. There has been some stuff with Bowser where it's been more pro-business, and you're getting I feel bad for these investors where someone is, these tenants, they're taking these leases with no plan to pay because they know they can't get kicked out for a year and a half. How is that a good thing?
That's not a good thing. Well, the other thing too that we failed to mention is that Commander Redskins Stadium gets approved.
Yeah.
Oh my. And we're already starting to see it because I have a property that we got as a tax lien certificate, right? We redeemed it in a place called Lily Ponds.
Okay.
Lily Ponds is literally walk across the bridge over the Anacostia. You're at RFK.
Mm-hmm.
Right?
Yeah.
That property is going on the market today. And before it's on the market, we already got an offer to full price on that property. And I'm talking, it's in like the under $500,000 price point in Lily Ponds. It's a small townhouse.
I mean, it makes a lot of sense. I was in San Diego. I used to live there for 13 years when they built the stadium right in the middle of the gas lamp, which is the downtown area, which was a very bad area at the time. I mean, just to see the flourishment that occurred around the stadium and the excitement, and it would have been such a fail if they couldn't have gotten in DC, but I'm glad they figured it out.
Now, the only other thing that DC has to figure out is they used to be called DCRA. That's called Department of Building. They have to do a better job of working with our developer friends and fast tracking these projects, because one of the things that we don't like to see as a private lender or even as a buy and fix and flip investor is we don't like to buy if we can't predict the market, let's say outside a 6-month window, right? We want our borrowers and ourselves, we want to get in there in 6 months or less, get that thing on the market and get it sold, because we cannot predict further than 6 months.
What is the answer to speed that up? I mean, I don't know the answer. I mean, is it the government needs to invest in more employees to approve it?
See, you just can't throw people at the problem. The problem is you got to throw a skilled labor force at the problem.
Yeah, you have to have smart engineers.
You do, because the city, let's face it, in a lot of areas of the city, you're talking about older inventory. And when I say older inventory, I'm talking 1910s, 1920s, 1930s. And these guys have got to understand the underlying infrastructure underground. But the skilled labor isn't going to be in what people are talking AI, this or that. This is actual people that have in-depth knowledge of the inner workings of the infrastructure of that city. That's what they need.
In a sense, if they're going to raise money or they're going to spend money in the budget, it's almost like you're going to hire skilled labor and you need to pay them well so that they come and do it.
You have to.
Right?
And not only that, we also need more good engineer architects in DC that know who these key people are.
Yeah. I mean, look, at the end of the day, if you're a developer and flipper and currently it takes you about 1.5 years on a project because it's so slow for the permitting, and you can move that to a year. First of all, I think builders and developers would have no problem with a little extra tax to employ more engineers. That could speed it up. So I actually think you could probably fund it, without having, what I'm saying? You could actually fund it through the community.
I totally agree. And so one of the things that they have been doing is something called a fast track program for developers, especially if you're building a pretty good sized project. Come on, it was 20 grand.
Yeah, sure. Charlie, thanks for coming on. Wealth of knowledge. I appreciate you kind of sharing your knowledge and educating the crowd. Yeah, for people out there that want to work with you, that want to borrow from you, learn from your education, what's the best way for them to check it?
Instagram, Facebook, LinkedIn, at Charlie Einsmann. Very simple. CharlieEinsmann. We're all over the internet, so find us. We're there.
We'll link it in our podcast. Thanks a lot.
Thank you.